We're going live. All right. So there's always the
All
first
right.
awkward few seconds where we don't know if we're live or not. Yeah. So anyway, I put up the title of this only about an hour and a half ago. We're just going to talk about oil prices. We're going to talk about inflation. We're going to talk about the chances of recession, whether or not you've kind of reevaluated what you thought earlier in the year. I know that I have based on my experience, of course, working for the oil industry, especially, in finance. Um, yeah, so basically that's kind of what I wanted to start off the conversation with. Epic Hamster says, are we drinking on this one? Hey, I actually decided to cut back quite a bit on drinking. I usually don't drink in the morning anyway, but I decided to cut back quite a bit on drinking and took one of my days off the table right now. And that happens to be for that Wednesday podcast or that Wednesday live stream. So that's not going to be, I'm not going to do that for a little while. Yeah. Epic Hamster says, boo. Yep, I get it, buddy. You know what, though? I've lost about 30 pounds since the middle of December, and very few people have noticed. All right. So, on the discussion when it comes to gas prices, that is a huge issue right now for lots of people. And it's also usually one of in the last couple of recessions, it's been one of the telltale signs that we are going into recession. Although I'm going to argue that that is an issue of correlation and not causation. And we're going to get to that here in just a moment. But let's talk about the reasons why gas prices are going up, while oil prices and crude are going up. And a lot of it has to do with supply chain issues. I'm talking about what happened before the war in Ukraine started. Most of it happened with collapse in demand in 2020, also coupled with an oil war that started in January, December, January 2020, that a lot of people don't remember, right? They don't remember that in December, January 2020, Russia started pumping, oil out like they had never done before. And Putin actually stated this publicly. He was doing it in order to drive U.S. shale producers out of business. And, that strategy basically got ruined in April of 2020 by COVID, when there was demand destruction anyway because of COVID. And, but that was literally the aim. So Putin's actually been engaging in economic warfare with U.S. drillers for quite some time. But there was an article that came out yesterday where Pioneer, the CEO of Pioneer Oil, got on some show. I don't know what it was, but they were saying, hey, now that oil's at $100 a barrel, are you going to start drilling again? And the answer for him was no, we're going to stick with our CapEx plan that we put in place a couple of years ago. Here's the problem, though. That CapEx plan that a couple of people that companies put in a couple of years ago, I think most of them are going to stick with that plan because they've gotten burned over and over and over by cycles. What's going on in oil markets. You and I talked about briefly about the derivatives market and how that's going to drive buying and selling here in the future. So if you think gas prices are high now, you think oil prices are high now, I'm going to tell you something. It's not over. It's really not over. And there is a real disconnect right now between call options being sold on the stock market versus call options on oil right now. And I think that it's a really good time for you to sell call options on stocks right now. Really bad time for you to get into the oil derivatives market if that's what you are looking to do. So, anyway, Tim, let me introduce you. You are a former coworker of mine. I have no financial relationship with you, no agreement, anything like that. Like many of my old coworkers, you went out and started your own company, and now you run. It's TK Financial. Is that what it's called?
Yeah. I actually changed my name
Okay.
to CWise Financial. So like you said, we worked together a few years ago. I've started my I run a financial planning and investment management firm here in North County, San Diego. So not too far from you, Jason.
Yep.
We obviously worked together as wealth managers, and in a prior life, I was a bond trader.
Right.
So inflation and interest rates are kind of near and dear to my heart. Was also a portfolio manager and financial planner at UBS, and excited to be here. You kind of, I think, encapsulated what's going on pretty well. I do think that we're going to be in a pretty tough spot. Obviously, like you mentioned, this was already in progress as far as what's been going on in the world, but it just seems like, you know, as of Jan 1, literally everything just started happening. You mentioned just reevaluating some of our outlooks, and we're definitely doing that here. And I have changed somewhat my outlook on what may happen through the end of this year into next year, and it's not, honestly, it's not looking great.
No, it's not. And I was quite a bit more optimistic January, February timeframe. Like a lot of folks, I thought that Russia was probably not going to invade. I thought that Ukraine would capitulate a lot more quickly than this. I'm pleased to see that they haven't. Not going to go deep into a political argument here or argument of right or wrong. Just want to say, let's look at the economic consequences here. I think that it's changed the picture quite a bit, and for a couple of different reasons. Number one, we are going to see, in all likelihood, that Russia is going to default on their bonds. April 1st, they're probably going to miss their first payment, right? That says nothing about, and we're talking about just the bonds that the government has issued. I think they have $117 million they need to pay in dollar-denominated bonds. They're probably not going to be able to pay this amount, or they might refuse to pay this amount or try to pay it in rubles. So the Russian government already passed basically it's Putin already passed a rule saying that companies can pay their dollar-denominated bonds that were sold to individual investors, institutional investors. They can pay those in rubles. Nobody wants rubles. So these companies have essentially defaulted on bonds too. And there are some banks here in the U.S. That have billions and billions of dollars of exposure to Russia. Now, is it bad? Yes. Is it that bad? Probably not. They don't have like 50% of their bond portfolio in Russia. It's a much smaller position because it's always been considered an emerging market economy. It's still not considered sort of a first world economy. You know that. But it's going to spread a little bit here. I'm not anticipating a 2008 like meltdown for a couple of different reasons. Number one, Russia's economy is actually pretty small compared to the global economy as a whole. They make a real small chunk of it. People keep saying that their economy is the size of Italy's. A better comparison is really it's about the size of Texas's economy, right? So Russia's entire economy is about the size of Texas, right? Just to give Americans sort of a really good visualization of how large the Russian economy is. So if you took Texas's economy just out of the United States, it would hurt quite a bit, right? If you take that out of the world, it doesn't quite sting as much. You know what I'm saying? But we are looking at a much greater chance of an actual academic textbook definition of a recession, which is 3 consecutive quarters of contracting GDP. I think that's more of a reality today than it was just 4 weeks ago. What is your opinion on that, Tim?
Yeah, I think you're right. Like you said, the size of the Russian economy is roughly the size of Texas. That's the data point that's been spread around, and so you can withstand that, right? As a world economy, where you do end up having to keep an eye on things is how interrelated Russia is with especially Europe, how much they trade together, how much European banks are how many denominated Russian debt do they own, how much are they going to be impacted. One of the biggest if you look at some of the research that a lot of sell side firms and a lot of investment firms were pushing through the end of last year was Europe is finally going to get out of their malaise, right? They've been trying to pump money into their economy. Their keep rates really low. We're finally getting out of COVID. Everybody is piling to Europe, and bang, this happens. I think it's an instant recession for Europe. They're going to be in trouble, and that's obviously going to filter out to us in some capacity.
Yeah, that's actually one of the really sad things. Like from 2008 until the end of 2021, Europe's economy had really been dragging, and it looked like they were finally kind of going on that ramp up. They were finally going to crack 3% GDP growth,
right?
And then this happens, right?
Right,
and it's kind of amazing. Like we consider their economy to be a little bit. It's more slower growing than the U.S. economy, of course. Definitely more slower growing than a lot of Asian emerging markets. But when you look at Western Europe's economic growth versus like Russia's economic growth as well, there isn't even really a competition there. You're looking at, Russia's basically grown their economy by about 8%, 10% since 1991, not annually, totally since 1991. The wealth has simply shifted to very few individuals within that company or country. They've been able to concentrate wealth and create an appearance of wealth, but really their per capita GDP has gone from about $8,900 per person to about $10,300. So that is not and that is not indicative of a healthy economy. And I think their economy is actually toast, not just now, but literally for a generation. It took 20 or 30 years to build investor confidence to bring money into Russia, like to bring Western money and particularly British money and American money into Russia. I think with all this talk now of nationalizing certain industries in Russia and the sort of buy-in on decoupling from the world economy, I think that no matter what happens, it's an investment opportunity that's kind of ruined for a generation. And I think we have to start planning ahead for that. I think we need to also start planning ahead for declining oil production from Russia as sanctions start to bite. Not just, even if we started buying Russian oil again tomorrow, I think we're going to be looking at declining oil production, just like we've seen with Iran, just like we've seen with Venezuela and a number of other countries that once they're put under sanctions, even if we start buying their oil, they have problems keeping up with production. So that's kind of one of the big deals. So let's look at a few things here. Dewey says, "Hey Jason, I found 30 pounds you lost." Okay, that's not the question. All right. So just as a reminder, guys, the super chat features are on if you feel so inclined. Also remember that because of the software we're using, I don't necessarily see every single comment out there, but I will try to get to your comments and answer questions. Probably not going to talk a ton about individual stocks today. I did want to say that today was the day that I finished funding my Roth IRA for 2022. I mean, today's just a perfect day. Markets down, especially emerging markets are down, especially China is down. I did end up purchasing a little bit more XBONG, a little bit more NEO, and quite a bit more in the way of SoFi. Right? I still see SoFi as a generational opportunity here at this point. And they're doing really, really well. I haven't come out with my update video on them, but I will. So we're not going to talk about too much and look at Epic Hamster as well. All right, so let's talk a little bit about sort of the waves of pricing here that's going to go on with oil markets right now. What you're seeing right now with oil markets is a combination of two things. It's a combination of current panic, and it's a combination of earlier panic and derivatives trading, people buying call options on oil, right? So the price of oil was rising because before this, from the middle of last year until January, price of oil was rising simply because demand was starting to outstrip production, and that's normal. Normally, demand starts to outstrip production. It brings a lot more people into the market, a lot more drillers into the market. They go out, they find financing. All these people that went out of business in 2008, 2014, 2020, they're able to go back, form new corporations, new master limited partnerships, whatever they're doing, go out, start drilling again. So what's happening right now is purely financial when it comes to the oil industry. Payouts and dividends from some of your drillers and pipeline operators are so high right now, and a lot of customers are really enjoying this because of this increased inflation, that they don't have enough money left in order to finance their own drilling operations. So they're going to banks and asking for financing, and the financing isn't there because drilling is really, really a really, really risky proposition. A lot of times I feel like, what was it? Jen Psaki was mentioning in a press conference the other day that 9,000 oil leases are unused. Even if all of those 9,000 oil leases are unused, there's a large percentage of them that won't have oil, period, right? And she's talking about the 9,000 oil leases that are on public lands, right? And those have not been exploited by oil companies. A large part of that is, like I said, due to Wall Street, not necessarily the oil companies themselves even, and certainly not to government policy. There's a lot of risk involved with drilling. And it wasn't just Pioneer Oil, like I mentioned, who's not going to change their capital expansion plan. So many companies, shale drilling companies, went out of business between 2008 and 2020 because they expanded too quickly, and then we saw a collapse in demand. They're not going to risk that again. If you think the price of oil is high now, I think there's a possibility it could briefly reach $200 a barrel. Now, this is no more real than it was when it reached negative dollars per barrel in 2020. This is all driven by derivatives trading. And in this case, it's really, if you think about when you buy a call option, you're taking a bearish position on oil, right? You're saying it's probably not going to go over this level, and I want to make money on my, by collecting that premium. So right now, people are selling options on oil. They don't actually have the oil. They're selling the options on the oil, hoping to make money. If the price rises or doesn't rise, they're maybe selling put options on oil, whatever it is. But a lot of the price action right now is being driven by excessive derivatives trading. This is what happened in 2008 when oil hit $150 a barrel. We didn't have so much demand in 2007 and 2008 that would have made oil hit $147 a barrel, I think, at its peak, all driven by derivatives trading. We haven't gotten to that point yet, but we will. It is absolutely inevitable at this point. Anytime you have a supply shock like this, you're going to see an amplification of the misery because of derivatives trading. We don't have an effective way to manage this. People are going to make a lot of mistakes making long-term investments thinking that the price of oil is going to be up forever, or long-term investments they're going to make some short-term decisions that they think are really long-term when they're not. And this is what I'm really worried about with investors. So right now, I would not necessarily be dumping money into oil companies as an investment. They make money off of volume, not necessarily the price of oil anyway, when it comes to production. I mean the volume that they process. But that's not where I would be putting my money right now. Liquid natural gas is going to be the real big winner out of what's happening right now between Ukraine and Russia. That is going to be the huge winner. Western Europe is absolutely going to be forced to really have the conversation about how they're going to diversify their energy supplies. And the United States is going to be a big winner when it comes to liquid natural gas. We are the Saudi Arabia of natural gas. Anyway, that's a really long rant on the energy industry. A lot of you guys don't know that I actually worked in the energy industry for a while on the financial end. And so I'm really well versed in this. I've been an oil investor for a long time. I've been slowly sort of extracting myself from the oil world over the last 3 years because I think that oil has essentially reached its peak, and that over the next 2 decades, oil companies are actually going to decline. I do think, though, there's probably a 10 or 20-year opportunity in liquid natural gas as we sort of wean ourselves off of fossil fuels over the next 10 or 20 years. So anyway, what do you think about that rant there, Tim? So
yeah, let me unpack that a little bit. So obviously we're in this world and know that kind of the intricacies better than I do. But I guess I would go back to one of your points is we watched oil and natural gas, and especially all the companies that were issuing MLPs and through the middle part of the 2010s, and they all got burned. I mean,
they all got crushed.
The investment went right. All the investment went in. Investors were told that these are just pipelines. They're just toll roads. That the price of oil doesn't matter. And bang, of course, everybody gets burned. I think in 2016 when the price of oil dropped to like $40 a barrel. So I think we're getting this like you mentioned, it's kind of this perfect storm where we've got a supply shock. We've got excess demand from people that have been sitting at their house for a couple of years that are ready to travel. They've been able to replenish their balance sheets. They want to go out and do things. At the same time, we need to produce more. We're going to start raising interest rates.
Yeah, it's going to make it more expensive to borrow.
Correct.
More expensive to finance those drilling operations.
Yep. Are we really going to solve a supply issue by raising interest rates? Now, rates you could argue should be probably a lot higher, but I don't know that it's going to make anything any better. So I think I agree with you. Like we're in for a little bit of a tough time here. with the price of just energy in general.
So you make an interesting point. Like these companies have a something they could do right now to increase capex and have money available. They could cut their dividends. They won't do that because of the stock compensation plans that most of these executives and board members have. They're not going to cut their dividend to nothing in order to take that dividend, which, by the way, they're double taxed on anyway, right? Investors like it, but you don't get a tax deduction for what gets paid out on the dividend. So it's really service to your shareholders when you do that, right? And that's the reason many people own these stocks. You aren't going to say, well, your dividend is 4.25% right now. Let's cut that back down to 0.5%. So we have the money available to finance drilling operations. We don't want to go to a bank right now and pay 9-12% rates. And that's actually being generous on like short-term financing like that for drilling, where there's a 40% chance that you'll find nothing or it won't be commercially viable. I think prices are going to be jacked up instantly. Like financing terms really haven't been terrible for drillers over the last 5 years or so. They're going to get terrible here in the next 6 months. So what are our alternatives here? In the U.S., there actually isn't because we're not a socialist country, that the president actually can't control oil companies or tell people to drill or make it easier to finance. I don't think there's really a way to automatically increase pumping oil. You just have to wait for the market to take care of it. It's actually easier for us to go to countries that have nationalized oil and say, pump more oil. Like we can do that. We can't do that here. It is simply not the way the oil industry works, and folks do not realize that. They don't realize that no politician really has control over oil markets. So I'm waiting for someone to mention the Keystone Pipeline. Please don't. That's the dumbest talking point that I've heard in the last 2 weeks. Is like, if Keystone was open, our prices would be lower. And by the way, I'm not appropriating that accent. That's where I'm from. So
you're from West Texas, right? So you can do that.
I'm from East Texas, but yeah.
Oh, East Texas. Okay.
East Texas, like East Texas, where people, very few people have a full set of teeth. But yeah, but anyway, I'm making that joke, and I'm sort of making that joke, but you have to have lived in my my hometown to really understand that. So but no, the sort of trouble surrounding the industry here in the U.S. is not going to be solved by any executive order. It's not going to be solved by any action by Congress. It's a matter of financing and risk. And that is what's going on right now. And the motivations for these companies to cut their dividends, to have money, to drill more, it's not there. It's not going to happen. Especially in an inflationary environment when the pressure for these companies is actually to raise their dividends. So they're going to have to go out if they do this. And there's a lot of companies that are going to fail doing this. They're going to go out. They're going to get very expensive financing. They're going to drill. Maybe they find oil. They find oil that's very expensive, meaning that it's probably not profitable for the company to take it out of the ground unless oil is at $75 or $80 a barrel. A few years down the road, the price of oil drops below $70 a barrel again. This company's going to go out of business. Your dividend's going to evaporate, and they're going to go into bankruptcy. And how do I know this happens? Because this happens all the time. Oil is a cyclical business. It happens all the time, over and over and over. I think that the big winner in all of this, though, is going to be that the electrification of transportation is just going to accelerate. It really is. And we have a whole new areas we should be thinking about investing in. And I think that investing in the whole lithium battery supply chain, the whole thing, is actually going to be a really good multi-generational way of looking at the economy. I think we are really hitting this point right now where the economy is changing so quickly, and so many people are going to be left behind if they're not very forward thinking. Stop looking about all the investment stuff that worked in the past and start being very, very forward thinking. What's going to be? Don't even look 2 years in the future. Look 5-10 years in the future, because we can't predict a damn thing for the next 2 years. But there's a couple of things that I can predict in the next 10 years that are probably going to happen. So, yeah. Anyway, Paulo Mateos, longtime subscriber, says, "What's on your watch list for this time, guys?" For me, it's actually liquid natural gas. Like I said, there's going to be a good 10-year push where we're going to see a huge expansion in liquid natural gas infrastructure, which also, by the way, means shipping. Those are shipped not in container ships. There's like specialized liquid natural gas transportation ships, and there's specialized port facilities that have been constructed in Germany, Hamburg, and then one other city in Germany and another place in Poland. There's a pipeline that just got completed from Norway, or is in the process of being completed from Norway to England. You're probably looking at UAE investing a lot of money in shipping so they can move out liquid natural gas, and Morocco as well, probably going to be buying some liquid natural gas transportation vessels. And so the reality is that we cannot replace Russian gas right now in Eastern Europe. It can't be done. They're either going to have to buy it or they're going to go be cold. And I've had one person tell me, I'd rather be cold than be a slave to, and this is a person in Hungary. He said, I'd rather be cold than be a slave to Putin. And I believe him. He says that's the general sentiment there. I believe him. But yeah. Anyway, what do you think, Tim, about sort of investing in lithium battery supply chain? You understand?
I think, yeah, I do. So I guess I'll keep things maybe a little bit general so my compliance department doesn't kill me for
just as a reminder, guys, he is a licensed professional. Unlike your average YouTube Yahoo, he can't just run out and say anything he wants to because there are people watching that'll slap him on the wrist. Okay.
Yeah. Right. So I guess I to your point, I think that we need to be looking not towards what worked in the past, right? Which was last 10, 12 years. Rates have been very low. Venture capital funding, technology, Bitcoin, Web3, you name it. That's the sexy stuff, right? I do think that if we're and I believe this, we're kind of in a new regime starting maybe Jan 1, which is higher rates, more inflation. And that stuff's just it doesn't work. It just, when we have those types of changes, you have to start thinking about other things. And I just printed this out. I thought this was interesting. If you think about last 12, 13 years since 2008, FANG, right? FANG stocks. Just buy the dip, FANG stocks, Facebook, Apple, Amazon,
Netflix, Google. Yeah.
Right. FANG. You're going to be fine. Yeah. And those did amazingly well.
Right.
You could see this regime change. And so Merrill Lynch just put out their new list of FANG. So I don't know if you've heard this yet.
No. Let's talk about that.
Instead of Facebook, Apple, Amazon, Netflix, Google, fuels, aerospace, agriculture, nuclear and renewables, gold, metals, materials.
Okay.
New FANG.
That's the new FANG.
I think that
sounds like an old FANG, though. That's like a pre-2000 FANG, right?
Exactly. That's your 2000 to 2008 FANG, right?
Yeah.
Which is exactly what
I was even thinking pre-2000 FANG, yes.
Yeah. So the kind of the regime before that was you kind of, it's your Berkshires, right? It's your free cash flowing companies, companies that can pass on higher prices to consumers, dividend payers, you name it. So I think that's where we need to be looking. And I think that people that are going to be looking in the rearview mirror for what worked over the last period, I don't know that that's going to work again in what we're dealing with right now.
No, I agree with that. So I hadn't seen that article yet. I'm going to take a look at that when we get offline here. I think importantly, though, one of the big sectors that doesn't exist now that is going to be a major industry in the future is energy storage. As we move into using more and more renewables, we are going to need to store that energy because it's not available at all times. Like solar and wind is not available at all times, but at times you overproduce. How do you store that energy? It's not just going to be like lithium battery storage. We're going to be using a lot of things like gravity storage. Like when the sun is shining, you're pumping water uphill. When the sun is not shining, you're using water running downhill to generate electricity at the same time. And that's just a real simplified idea of one of the ways we're going to be thinking about energy storage in the future. Like basically you're storing solar energy in the form of potential energy by pumping water uphill and then using it later when the sun is not shining. It's not just going to be like lithium ion batteries, and it's not just going to be like like energy and renewables, energy storage, I think, is going to be one of the largest major industries that appears out of what is going on right now. And I made a video on this like 2 years ago. It really didn't get any traction. I don't think people really understood what was going on. But Tesla's energy company, I think that their original intention was that like energy generation in the form of rooftop solar was going to be their largest contributor to revenue. I think that's not going to be the case. I think that the large grid scale storage facilities are going to be the largest contributor to their revenues going forward. They've got these massive battery, farms that are basically look like shipping containers out in the middle of nowhere, and they store gigawatt upon gigawatt upon gigawatt of energy. I think we're going to start seeing those in a lot of different places, and there's a lot of other really exciting technologies that are coming out with like hydrogen fuel cell technology for like backup power with sodium ion batteries used in like stationary, power storage situations. That is going to be a huge industry going forward. If we're going to be more dependent on renewables, the way to sort of even that out and have better management of that power is going to be energy storage, which we have essentially zero energy storage right now for the grid. We produce everything as we need that demand, and that's not working as our energy demands increase. It's just one of those very interesting things here. Let's get to a few comments here. Oil will collapse when people see the advantage of electric transportation. For example, I'm not sure when you say you, or are you talking about UPS or Upstart is buying 20 battery electric locos for yard work, or Union Pacific is what
Union Pacific.
Union Pacific. Okay. I'm not surprised that they're doing that. Not surprised that they're doing that. I think more and more of that is coming. Like I noticed some of the first, so there's a parking lot near my house, like on the highway, and it's an Amazon parking lot where a bunch of Amazon trucks park. And there were a few vehicles that I didn't recognize out there. And as I was driving, I kind of slowed down and looked, and one or two of them had no labels on it or anything like that, but I saw a charging port and they were hooked up. So I haven't had an electric delivery van come to my house yet, but I know that they're testing them in my area. So I think that sort of like last mile delivery electric van is coming here pretty soon. And I think all that's very interesting. So yeah. I think that's going to be one of the big winners out of what's coming right now, and the oil shocks that are happening right now it's just going to increase. And so FYI, I used to be Bram. Yeah, I recognize that, buddy. So it's your profile picture hasn't changed that much. So he's one of my first subscribers from Canada, actually, and one of my very, very first subscribers. And I think I was still maybe just over 1,000. Dewey says there's already an XL pipeline called Railroads. Yeah, thanks for mentioning that. There's actually an XL pipeline that has been in operation since 2010 and is still in operation today, which if you listen to certain propagandistic media, you would not understand or know that all of that tar sands is still being pumped through the U.S. and being exported through the port of Houston. So none of it was stopped by stopping the Keystone XL extension pipeline. None of that was stopped. It's all still being exported. Every single one of those barrels. But actually, none of that is used for gasoline anyway. It's actually used to manufacture plastics, and most of it is actually shipped from the port of Houston or through Mexico to China, where it is made into plastics and then sold back to us. So even if the XL pipeline the extension had not been canceled, it wouldn't have started pumping oil till minimum 2024, 2025, would have no effect on gas prices today. So that is a point that is missed by the propagandistic media that a lot of people are consuming. And you just aren't actually getting facts. If you believe something different, in fact, you can go to TC Energies, who runs the XL pipeline, and look yourself. If you believe something different, you are simply factually wrong about that, period. And that's go to TC Energy's website and look for yourself. They've been running the XL pipeline, the Keystone pipeline rather, for since 2010. The XL was an extension, a shortcut to benefit a private Canadian company to export oil that never would have been consumed in the US until it came back from China as plastic products and not gasoline anyway. If you believe something different, you're just wrong. So that's it. So it's yeah. See here. What battery stock companies are you invested in or looking to invest in? QuantumScape. QuantumScape is an absolute no. So I don't know, Tim, if you ever looked at QuantumScape as a company or their technology. So the problem with solid state batteries is that I don't think that the technology is quite there yet. There's actually a technical hurdle that hasn't been overcome at this point in terms of battery longevity. And I would know if it was overcome at some point because there would have been a white paper published, there would have been an article published in academic journal, or it would have been leaked in some way. And basically, I know that hasn't been overcome yet because nobody's leaked it because scientists can't keep their mouths shut. If they discover something cool, they'll talk about it, right? And this is one of the reasons why I think that QuantumScape is years and years and years away from profitability. I mean, 8 to 10 years away from profitability if they survive. So they may have like a commercially viable product by, say, 2027 at the earliest. But they won't be in volume production till later than that, 2030 maybe. So I could be wrong, but it's not going to be wrong by much. I think you're going to have opportunities to invest in QuantumScape at a sub $10 level here pretty soon. And when people start to realize that. But in terms of battery stock companies, I would not even venture to look at an individual company at this point. This would be like trying to invest in automobiles in 1920. There were over 1,000 different companies, or actually 1,600 companies that made automobiles that were founded between 1880 and 1940. Exactly 3 of those survived until 2008. 3. That was it. And I think that trying to guess which battery company is going to come out on top is just a fool's errand. You're much better off buying a broadly diversified ETF. Even if you want to focus on that battery supply chain, buy a broadly focused ETF. Wait a couple more years before you dive in and say, I'm going to buy this individual battery company stock. It's way too early in this industry to tell kind of what's going on. So I want to move the conversation on a little bit, though, Tim, from this. Like a lot of my clients or my subscribers ask about individual stocks a lot. I know that's something you don't want to talk about. Let's talk about inflation. Let's talk about what the Fed is likely to do, because inflation hasn't been solved by higher gas prices, guys. And it's just creating another supply shock, which is probably going to increase inflation. So let's talk about what the Fed is likely to do on March 16th. What do you think? What's your prediction?
So, I mean, Powell's pretty much already said what he's going to do, which I think is the first time that's ever happened.
Yeah.
You know, a month before a Fed meeting, basically saying we are going to raise by 25 basis points. Just get off a zero bound, right? Yeah. I'd be shocked if he does anything different than that. I think what everybody's trying to figure out is, does he have the stomach to keep going, right? And so getting off the zero bound to 25 basis points is one thing. Market's pricing in maybe 6 hikes this year, I think, last time I checked. And
6 hikes in succession, not this year. It's a quarter point per quarter.
Yeah, correct. Yeah. In succession, correct. Yeah. And then I guess the question is, does he have the stomach to keep that up through potentially some kind of, a continued market decline, through potentially the bond market breaking like it did in 2020, potentially through some other thing that we're not even thinking about?
Actually, that is something that most people on YouTube in general don't understand, that we almost had an economic collapse in 2020 because the bond market almost collapsed, not necessarily because of COVID, because of that. And that is something you can speak on with authority. That's one of those hidden things that nobody really understands, that the bond market broke. Yeah, why don't you talk about that?
Correct. Yeah. So people think that there's this quote unquote Fed put, right? Where hey, if the stock market goes down by X amount, Jerome Powell, Fed, whoever is going to step in and save it, right? I would argue he doesn't care. He wants the plumbing to work. He wants the creation of credit to continue, companies that need to go out and get funding to get that funding, banks to be able to lend to one another. When that doesn't happen, that's when they really start to think about stopping what they're doing, right? And really starting to provide liquidity, because that did not happen because of COVID, like you said.
Right.
All the bond buying, all the repo facilities, everything that the Fed enacted in 2020 had nothing to do with the stock market. There was literally there were no buyers for any bonds. There were just no buyers. Yeah. And that is a problem. So that is what almost caused us to go into collapse in 2008. It almost happened in 2020. That is where there's going to be a disconnect, right? I suppose there's three separate outcomes here. And again, I don't know if I've seen anything this varied in my career, but the middle scenario is the Fed pulls this off, right? They're able to raise interest rates. The consumer can and companies can withstand all that. Inflation comes down, and we're back to where we were before. Almost nobody's positioning for that, honestly.
Yeah, I think the likelihood of that happening is pretty slim now. Yeah.
Right. Yep. Powell says, and I'll talk to anybody that's lived through the 70s, that inflation is the worst thing that you can have. Yeah. And so what do? You raise interest rates until probably you get a recession.
Until it causes recession. Yeah. Yeah.
Correct. That's one outcome. Yep.
Well, think about this. As a financial professional, if I say the name Paul Volcker, what do you think?
Right.
The guy's basically Captain America to me.
Yeah. Right? Yeah. He killed inflation. He killed inflation. He did something that was unpopular.
He did it. Yep. So, I mean, the big, so there's one school of thought economically, of course, that inflation is almost solely caused by government spending. But we know that that is not true, because Paul Volcker was able to kill inflation. And this is a lot of people don't realize that we didn't really have much of a budget deficit, and we didn't have a ton of debt until Ronald Reagan came in office. And he absolutely exploded the deficit and exploded debt. And at the same time, inflation went to near zero. How was that done? Well, it was done in pretty much the most horrible manner you could think of. Paul Volcker said, I don't care about your feelings. I'm going to cause a giant ass recession. And that's what he did. Short-term interest rates went up to 18%. It caused a giant contraction in money supply, made it very expensive to borrow. My parents' home, I remember this from a kid, they paid like 16.5% on their mortgage. Like my first mortgage was like 9.25%. Right. I mean, that's what you paid. Like people don't believe it when I say that. But, to me, Paul Volcker was a hero. He ended, almost a decade of stagflation. He did that by hurting millions of regular Americans, though, like tens of millions of regular Americans. But he basically saved American currency and the economy. I think that Powell definitely has the stomach to do that. I think that ending up being remembered as a Paul Volcker-like hero to the financial world, I think he's definitely willing to do that. We are approaching one of those, like I said, inflection periods where are we going to have runaway inflation, or are we going to do what is painful but necessary, which is to have an engineered recession and contraction of the money supply? And I think he's willing to do that. If he's already pricing in six, quarter per quarter for the next 6 quarters, 6 rises in interest rates, that's probably not going to be enough. Right. I honestly thought there was a good shot that on March 16th, they would raise by 0.5%, by 50 basis points. That's probably not going to happen now because of the Ukraine conflict. But I think there would have been a good shot for that happening initially. I think it'll be more aggressive than.
I agree. I agree. The pushback that I would hear on that is, if we start going back to the .com bubble, right? And so if we look at what the Fed was able to do, I think they were able to raise rates up to about 6% in late 2000. 99, 2000 causes a recession. We come right back down. 2008, we were able to raise from, I think, 04 to 06 to about 4%.
Right.
Comes back down. 2018, we were able to raise about 2%.
Before it comes back down. Yeah.
Do an about face, come right back down. Where's the upper bound going to be?
I think that he's going to blow past the upper bound and collapse the economy on purpose to reset the rate regime. If you look at, basically, I think that we need to have short-term rates in the 4 and 5% range in order to have ammunition for the next time we have a real crisis at hand. Let's be clear, we're not at real crisis. We're not at anything that we can't recover from without having ammunition in our pouch here. 2008 was one of those periods where we had a real crisis that could have collapsed the global economy and caused a generational depression. and they had to invent new tools to get us out of that because there wasn't enough in the way of interest rate rooms to manipulate that. And there wouldn't have been enough in I don't think there would have been enough stimulative power of lowering interest rates, even if we had just had a normal recession. They still would have had to come up with something different. And that's, we aren't at that position right now. And that's what a lot of people don't realize. But I think it's worth it. And this is a crazy idea because it's actually going to hurt a lot of people, you, me included. I think that it would be worth it to reset expectations when it comes to what interest rates should be like. And what I mean by that's a horrible thing to say. I mean, to engineer a year or 2 year long recession in order to get us used to the idea of borrowing money and having that risk properly compensated for. Like, I don't know about you, but I would not loan anybody money for 2.3% annually. And that's what bonds were for a long, long time. They were below inflation for a long time. I would not loan anybody money for that. The risk that they're going to default on that loan in that 30-year period is just far too high for me to do that. I have to be able to price risk in, and government interference and printing money and it has really interfered with that natural market process. But if you want less interference in the market, you're going to pay a higher price in terms of interest rates. And so the question is, what do you want? Do you want lower inflation? Do you want the Fed to be able to fight future recessions? Or do you want your cake and you want to eat it today? Right. And that's really the choice we're facing.
Great point. I mean, you could argue that we should have had a longer and tougher recession during COVID.
Yes, we should have.
Didn't, right?
Yeah.
We should have, right? And so we were able to kind of manufacture our way, for a very quick V-shaped recovery. We had I believe the fiscal, the checks being sent out. I think that had a massive impact. But you could argue that we needed to take our medicine. We never did. And so does he have the stomach to make us take our medicine? I think he does until it breaks something. And where that is, that's anybody's guess. But I do believe he's got the stomach for it. If you want to be a hero as a central banker, I don't know how many people want to do that, but if you're the guy,
it's a weird world, man. Like, I worship Paul Volcker. The guy, he had all the pressure in the world. Everybody hated his guts, and he did what was right. No matter what anybody said about him, he did what was right. He had to be the most hated man on the planet in that time period. But look, like, how do you get more people in the bond market and make it healthy? It's not by having the government buy bonds forever. It's by having interest rates that are attractive for a long-term investor.
Yeah.
You only do that by raising interest rates, and you only do that by stopping the bond buying program. But that's going to suck money out of the economy, right? So you are stuck here. What do you do? And I know people always want to relate this to government spending and government programs. The evidence to back the assertion that that inflation is a result of government spending is not actually there. It is not actually there, and that's based on a number of different studies that have been done. It's just more complex than that. Everyone that says inflation is simple, it's because of this reason. It's not. It's a combination of reasons. It's very simple. Even economists don't really understand why it's happening. It's not just us, guys. It's worldwide. In fact, if you look at World War II, one of the primary motivations for Hitler to go to war, besides being an asshole, was because of inflation, right? That's actually the case right now with Putin as well. His country was facing inflation. The ruble had gone from 40 rubles for the dollar in like 2010 to 80 rubles for the dollar by I think November of last year. Lost half its value against the dollar in that time period. He's facing, and now we have worldwide inflationary pressures. I think that was one of the motivations for him going to war as well. And I think that the ECB, the European Central Bank, the Fed have really different motivations. Like the Fed has a much wider mandate than the ECB does. The ECB has one mandate, and that is to control inflation, because they see inflation as one of the major causes of conflict. I think that's actually been kind of proven true again. It's one of the major contributory causes to this current conflict. What do we do about that? And I think what we do about that is we endure pain. And it's a very unpopular, and every time I do one of these live streams, I lose subscribers. because I say things that are unpopular and true, right? Unpopular and true, and people don't want to hear that. And so if you're listening to this right now and you know and you don't think I'm a jerk, go ahead and subscribe. But no, what I'm saying is this is probably what we need to do. Does the European Central Bank? I think the European Central Bank definitely has the balls to do this. I think that Jerome Powell does as well. I think that it really does. But you're correct, though. 2018, I think that our economy was a bit more fragile in 2018, and that him threatening to raise rates up to 2% caused it to collapse. And and then Bram makes the point that the ruble's at 133 rubles to the dollar right now, and that's not an improving situation, right? So I kind of lost my train of thought there, but no, Jerome Powell having the balls to do this, I think that he does, and I actually think that what's going on is kind of perfect cover to do this, right? With gas prices being so if you look at the CPI excludes the cost of food and fuel. Right. So that's not even in this. They're looking at the core cost of consumer goods. It's up by almost 8%, 7.9% on an annualized basis, which is terrible. It's not as bad as it can get. I mean, we're not Zimbabwe here.
That didn't even reflect any data from the invasion. I mean, that's even before that.
Yeah, it's even before that. Right. And but high fuel prices, I think, actually give him the perfect cover to do this. They really do. So what is that going to affect? I think that that when you look at REITs, apartment REITs are going to look very attractively priced 6 months from now when we see interest rates rise, we see their borrowing costs rise, but we see their dividend payouts actually increase as more people are forced to stay in apartments. So I think they're going to look very, very attractive. Some of them are. What a lot of people don't realize is we're still in the same situation we were in 2008. A lot of apartment REITs don't actually own apartments. What do they have? They have mortgage-backed securities in them. And with rising interest rates, those mortgage-backed securities are going to decline in value, which means that the price of the REITs are going to decline in value. So you have to be a little bit more careful about the sort of inflation-protected investments that you're looking at right now, especially in terms of rental real estate. You need to make sure that the holdings of the REIT are actually what you expect them to be. You'd be surprised how many of them don't actually hold properties, don't actually collect rents. A lot of what they hold is actually mortgage-backed securities. And if we have a rapid rise in interest rates, 0.25% per quarter is not like a rapid rise, but let's say by September or December, after the election is over, midterms are over, Jerome Powell's like, all right, we're raising 1%. That's going to have a really significant impact on some of those REIT assets. I don't know about you, but I am right now accumulating. I'm making some purchases when it comes to my personal investments, but I'm accumulating some cash right now because I think it's going to get worse, and I think there's going to be an opportunity to buy more at really attractive prices.
Yeah, I think you're right. I mean, we're kind of talking about, I suppose, a couple different things, like short term and long term, right?
Yeah.
I think the short term, like you're right. I think you almost have to think about a barbell, right? Which is very safe on one end. You're going to lose money by raising cash, short term bonds, whatever you want to do, to inflation. But that money, if you're going to retire, if you've got to start living on something, if you want to just build an emergency fund, that's just the cost of keeping something safe and something that's going to be able to like you said, add if we do get into a difficult period here. And then on the other side of things, the investors that have been in, if you long Triple Q or any of the FANG stocks, Cathie Wood, the ARC complex, you got to really think about the kind of the boring stuff, the Berkshire, that you mentioned. One of your viewers mentioned railroads and banks and materials, miners, gold, like all those REITs,
miners,
all those types of things. As rates do start to turn around and eventually come up, assuming that happens, those are the kind of companies that are going to benefit. And that's what I've been doing for clients, is really just trying to level set and try to be positioned for that change, because I do think it's happening. I don't know that we're going to get out of this anytime soon. That's not to say we can't be positioned for continuing to make money. It's just, it's going to look different. I mean, the portfolios I think are going to look much different in the next 10 years as they did in the last 10 years.
I do too. And it's a barbell strategy. I'm a heavy investor in technology because what's going to happen in the next 20 years is unimaginable. Just like, if you think about it, like my great grandmother from the family that adopted me, she was born in 1898, took a horse and buggy she had a high school education, but she was the only one in their family that did. Took a horse and buggy to school. She lived long enough to see men walk on the moon and send me an email, right? And it's crazy, right? That's just absolutely insane. She could not have conceived how the economy and life was going to change over that time period. I think that we are entering a period that's even faster changing than it was for her, and that we cannot even imagine what's going to happen in the future. And I tend to invest pretty broadly in technology at this point but 70% of my portfolio is actually really boring index funds. That's it. And the other 30% is all technology stocks pretty much.
Yeah.
But I don't ignore the boring investments, and you shouldn't either, because they're going to be solid performers. And especially when things are disruptive like they are right now, they're actually more solid performing. If you look at everyone's technology portfolio, if you invested in 2020, it was impossible to lose money until November of last year. And now everyone's down 50% or more on their technology portfolos. So this is the barbell strategy, where you have some investments that are extremely long-term, and then you keep some short-term investments where you're going to lose money on some of your short-term investments, but that is the cost of having them available. I think that's one of the things that everyone needs to consider at this point right now. And I think everyone should have an emergency fund right now that you're going to lose money on because of inflation, but because I think job losses are coming, and for certain industries, and in industries that performed really, really poorly over the last couple of years are going to be, in terms of jobs, are going to be the ones where jobs are available. I'm talking about service industry, restaurants, hotels, that sort of thing. People are going to be spending. People are coming out of the recession that we had in 2020, or the economic crisis, in better financial condition than we've ever had coming out of a financial crisis. But all that's about to get sucked up by inflation. And surprisingly, I think it's still going to go to a lot of unnecessary things like eating out, going out drinking. That's because people are just, the demand is still pent up to do that. I don't know if I told you this, but my bar is actually reopening on Saturday. The bar that I own. We've been shut down for 2 years because of COVID and because of restructuring, because of all that stuff. We finally got everything done. There was a risk that we never would have opened back up again. It's been 2 very long years. And now all this shit happens, right, in the middle of this. But, the demand, and I was really surprised that we have this event planned. I thought demand would be kind of lackluster. It's not. People are coming out of the woodwork to go out and party. And yeah.
That's awesome. Good for you. I was just a client of mine has a place in Colorado. We went just out for a quick ski trip. Typically very, middle of the week. We just try to get a couple runs in. The town was packed. Sunday, Monday, almost no tables for dinner. The mountain was packed. Everybody's spending money. Everybody is in a very good place, at least at this point, because of all the just being able to just kind of reinforce
2 years of pent up demand, man.
Exactly.
Yeah.
Exactly. So I'm hoping that, I don't want to be a Debbie Downer this whole episode, because I do think that there's some things that we can look forward to. One is, which is like, there's never been a better time for this type of thing with people that have been.
I think that no matter what the economy does, there's a massive rebound in the service industry. I think there really is. And I could not stand being a waiter a long time ago. When I was a waiter, I hated every second of it. I've talked to so many people that really missed that job. I'm surprised that they missed that job and they want to go back to it. They love
waiting. There's an energy working in a restaurant that you don't get anywhere else. There's maybe that's it. I grew up in restaurants, so I get it.
No, I absolutely couldn't stand it. But you don't know how many times I got fired from one of my best friends. Like laughed, like we met, and then like a week later I got fired. He and I had been best friends for like the longest time, and he looks to remembers like I must have gotten fired in this one small town like 5 or 6 times from different restaurants, because eventually someone would get me to say something that was offensive. So,
Not you, Jason. That's not the
me.
Jason I know.
Yeah, that's right. It's funny. But no, I think though that's going to be the one bright spot in our economy is that the service industry is going to look really well. Like I was telling everyone, I'm traveling somewhere this summer for a couple of weeks. I don't know where I'm going, but I'm going somewhere. I'm going to get on kayak or whatever it is and look for the cheapest ticket to a foreign country, and I'm going. And I don't even know where it is, but I'm just going to go somewhere and relax, party, explore, speak a new language, whatever it is. And I think a lot of people are in that same boat. The thing they want to do is just move, get out and do something. And I think that is going to be the bright spot in the economy, is that consumer demand is probably still going to be there. Even with higher interest rates, even with higher gas, there's still going to be consumer demand. And we are in fairly good financial condition compared to previous crises.
Never bet against the American consumer's ability to spend money.
That's true. That's true. Like the fact that savings rates look so good coming out of COVID was shocking to me, just stunning, because Americans don't save money. And honestly, I think that's what's going to help a lot of folks weather what's coming next. But yeah, anyway, this was kind of this is probably a shock, because normally I'm so optimistic in my videos, and this is probably, and I made a couple of videos saying earlier this year that I thought the chances of recession were fairly low, even though everyone's talking about it. Well, all that calculus has sort of changed in my mind because of what's going on right now and the price shocks that were going on. Didn't want to be a downer, but I do want to prepare you that oil prices have not stopped rising. They may have stopped rising over the last day or two, but you're only seeing the first wave of derivatives trading on oil, and then you're going to see the short covering here pretty soon, right? So that is going to push prices even higher. Be prepared for that. I don't know how you prepare for that. We're carpooling to events now. I'm driving less. I don't know if you are too, but this has just started, guys. The prices are going to be elevated for quite some time. Anyway, I don't like to close on a bad note there, but we are reaching our 1 hour time limit. I wanted to thank everyone who watched today. This is not my normal time to do live streams, but I'm going to start doing more live streams with you and Ryan and Amar and some other folks. And anyway, thank you very much for coming on today. Awesome. You can hang out here. I'm going to end the broadcast. You can hang out. I just want to discuss a couple of things with you.
Sounds great.
All right.
Thanks, Jason.
Thank you.